I'm Nick Grove for Morningstar.com.au, and today I'm joined by Head of Equities Research Peter Warnes, who's here to give us the lowdown on the ongoing fiscal 2015 earnings season. Pete, thanks very much for your time today.
Great to be here, Nick, as usual.
First of all, Peter, Asciano confirmed what looked to be a pretty handsome offer from Brookfields this week. Do you like the way the deal is structured, and are Asciano shareholders getting a good offer?
Nick, it's a good price. It's very similar to Japan Post's bid for toll. It's almost one that you have to accept, and the Asciano directors have unanimously recommended the bid in the absence of something higher, and I just can't see anything over the top of this. The structure of the bid, it would be cleaner if it was all cash, but I can understand that Brookfield would want to use some equity, and the equity will be listed here, which is positive, so that existing Asciano shareholders can share in the spoils down the track that Brookfield obviously see. So structure okay. We're not the shareholders, similar to what happened with toll. They're not going to get any rollover relief. They're going to have to pay the capital gains tax on the way out. But overall, look, it's a great price, and I think, strangely enough, those two deals tells you a lot about what overseas raiders are looking for. They're looking for logistics and infrastructure in Australia, and of course what's brought them here has been this fall in the A-dollar over the last year. If the A-dollar was 1-to-1 against the US, these takeovers would not have occurred. And so this is the price you're paying. We're paying for a low dollar. It's all very well and good to say, okay, exports are cheaper, this and we're more competitive, etc., etc. But there is collateral damage, and it's called losing an arm and a leg. So overall, the shareholders of Asciano should accept the offer, and then hopefully we can find some gems for them to reinvest those proceeds.
In the financial sector, we saw ANZ release a trading update and QBE release its half-year results. Did you take away any concerns from their earnings?
Well, Nick, concerns, no, albeit that the ANZ result was pre-announced, if you like, when they announced their $3 billion raising a week or so ago, which, quite frankly, I think was badly handled. They would have been better with a straight vanilla accelerated entitlement issue and wouldn't have got anyone offside. That caused a bit of angst in the market. In addition to that, the quarter was 6% below, the cash earnings 6% below the average of the previous two quarters. And the reason being that slowing growth in the international space and the institutional space, but in addition to that, elevated bad and doubtful debts. That was probably the scariest part of the result. But Mike Smith yesterday went through this and said, look, yes, we have got a bigger exposure to mining service or the resource space here and in the New Zealand dairy industry, and we mentioned that previously. He's not concerned it's ongoing, so we're comfortable that ANZ is in reasonable shape. The international or Asian growth strategy is a differentiator, but having said that, it's been the fastest growing region in the globe for a little while now, and what that's done, it's attracted the heavyweight global banks, and so competition has increased there. Obviously taking some wind out of the sails of ANZ in that space. But overall, the bank is in good shape. It needs to raise another $4 billion over the next 2 or 3 years. That should be done in an orderly fashion. We're comfortable with the outlook for them, for major wide moat banks, albeit that we know that this increased capital that's coming onto the balance sheet will have an impact on the return on equity, and therefore you'll find that the rate of growth in earnings per share and dividends per share will slow a little, but they'll still be very attractive. Now, in terms of QBE, this company looks like it's in the best shape it's been in for quite a while, and it's been a bloody rough road for them for 2 or 3 years. The result was good, up 14% the cash line, $477 million US. Now, and more importantly, they reaffirmed the metrics, the benchmarks of insurance margin and combined operating ratio. The balance sheet's in good shape, the capital's fine. What they've done, because it's been a rough patch for a while, they've also made sure that they're not going to get blown out of the water by something that's coming unforeseen, called, you know, a natural hazard. Now, what it is, God only knows. But what they've done is they've just upped the reinsurance cover, and that's taken the edge off the forward guidance on net earned premium, and that's positive. In addition to that, increased the dividend by 33% from 15 to 20 cents a share, and increased now the payout ratio to up to a maximum of 65% of cash earnings. That is positive, that's confident, and we think that that company is in very, very good shape now to re-emerge as a growth company in the space, and the global insurance space.
Finally, Peter, Newcrest Mining returned to the black and is paying off debt instead of paying out dividends. Are you happy with the way this company is currently being managed?
Well, Nick, yes, we are. It's a bit of a refreshing change because there's been a few hiccups at Newcrest for a little while. Look, the result was in line with expectations, 500 odd million at the underlying level. Debt was paid down, free cash flow was $1 billion, and they've used a lot of that to repay debt. Debt now sitting at about 2.9 billion US, and the maturities, 2 billion of it's long, 2022, 23, and heaven forbid someone lent them money out to 2042. So that's fine, and not paying a dividend and making sure, okay, we've got this debt really, really low is the way to go, but I think that dividends will be resumed maybe in the second half and certainly in 2016. Now this company is a single resource company, so it hasn't got a moat. Gold, you know, is in the doldrums, but having said that, they've got a great reserve life. I mean, Acadia is being upgraded. Lahire is they're trying to get in there and figure it out, and you find increased output from there. We're very pleased they kept Telfer, because Telfer is a big resource and a potential some higher grade there. And Wabi-Golfu is now, there'll be a decision on that, you know, down the track. It's just adding to mine life. So overall, comfortable with the way it's being managed. The capital allocation is correct. Let's get this debt down, and over $2 billion, as I said, out long term. The company's in pretty reasonable shape. All we need now is, and all they need now is for the gold price to reverse and go north, and that will make everyone quite happy. But dividends from Newcrest, not too far away.
Pete, thanks very much for your time today.
Thanks, Nick. It's always a pleasure.